So like everybody's pulling their weight. And right now it's time for us to pull our weight, Greg, because we are live on Facebook for the Thursday edition of the Not Your Average Investor Show, the rental income property of the week.
Week.
I'm your host, Pablo Gonzalez, my co-host, the man they call GC because of his genius concepts, because he generates cash flows, because he's a great co-host, and because his name is Gregg Cohen. Say hello, Greg.
Hello, everybody. Great to be with you. Welcome to the POT Dubs, the property of the week. I'm so glad you're here. Can't tell you how much I look forward to Thursdays.
I look forward to Thursday as well. And I look forward to Thursdays because of what's happening already in the chat today. We got Eddie from Hotlanta. We got Leo in the house from Leo's from California, I believe. Jake Hargrove from Memphis. I know that we got Leon from Baltimore. We got Everett here from Jacksonville. We got Gene Ferreter. Gene, I'm not familiar where you're from. If you want to put that in the chat there.
Gene, we also from New Jersey. Gene's been a client for a long time, and Gene, I believe, actually used to or still works at Johnson & Johnson, which is where I used to work, if I'm not mistaken. So, yep, good to see you, Gene.
There you go. We can't get one past you. And today we also got Kelly Van Eaton, who's here from Brussels, the beautiful city, historic city in Europe. And you know, for those of you that it's your first time, right? We said a lot of familiar names that are here. They're part of the community. You know that this is a interactive show. We want you interacting with us. The two ways to do that is the chat function that's already lighting up. Just a quick tip on that chat function. If you were just opening it up, it defaults to only speaking to Greg and I through that blue box that says panelists. If you want to hit that blue box, drop down menu, make it panelists attendees. Everybody can see you speaking. Like Gene, for example, you're only speaking with us. Pop, Everett, you're only speaking with us, but that's fine. If you guys just want to talk to us, that's cool. But if you want to interact with everybody else, we encourage it. Also, if you want to get your questions asked on the show, I ask that you pop open that Q&A button that you may have to hit the 3 buttons for more to open up and put the questions in there because you're going to see this chat function flies and we got a lot of things going on. So I'd like to keep the Q&A in front of me. I do my best either way. I just may go cross-eyed. It's not a good look for your boy. So help me help you. Also, if you want to download the spreadsheet that we are going to be tinkering with today, that is a way to break down all of your deals, whether it's with JWB or not. It's got all the information that you can make everything an apples to apples comparison for any kind of rental income property deal that you're going for. Go to jwbpassiveguide.com. And that's a whole guide on passive investing. It just also happens to have that spreadsheet. And last but not least, Greg, we've got the JWB Cares charity tournament coming up. I am super pumped about it. Greg told me a little bit before the show that I get to be the official MC of the tournament, which I'm really hyped up about, man. Thank you for this opportunity. And as official MC, my first order of business is to announce the 50-50 raffle that we're holding. And Greg, you want to tell them what this raffle is about, what JWB Cares is about, what people can contribute to in this raffle?
Well, we'll start with JWB Cares. That's our charitable arm. That's our nonprofit. And the goal here is to create affordable housing solutions and to really to give those in the community who need a helping hand as far as housing, that helping hand. And so our main, the best day of the year for everybody in JWB is the day that we get to actually build a brand new construction home and donate it to somebody who really can use it. And the last couple of years, we have donated a brand new construction home to a veteran who has served our country admirably, who has come back and has really struggled and really needed some permanent housing. And the stories of these gentlemen that we have been blessed to meet and how they have grown once they were able to receive this home for free and create this stable permanent housing situation for them and their families has been incredible. So we're super excited. We get to do that again, and it all gets kicked off with our charity golf tournament. So that'll be on Monday, March 1st. So coming up here, this will be our 4th annual charity golf tournament and the 3rd time that we get to donate a home. We have selected the new veteran who is going to be getting the home. He has no clue that it's happening. We will let him know just before the golf tournament. And we get to be surrounded by our network. Our sponsors are incredible who make this possible. Our team has been working the entire year and then some to prepare for it. And we love to invite clients to be a part of it as well. And we have a really special way for everybody who would like to be involved. I know many of you are in various parts of the US and in Brussels as well. And if you'd like to be a part of this, we have ways for you to help donate. Because the cool thing is that for us, our mission here at JWB and JWB Cares is we want to use this platform to do more and more in future years. We've been able to do one house a year for the last 3 years, but our idea is to do more. And I think it's a real possibility that come next year, we may be able to sit here on the show or talk to our current clients and talk about doing 2 houses next year. And that's really dependent on how much money we can raise. So I wanted to ask everybody, if you'd like to help us in our mission, come help us donate. And the best way to do that is through this raffle that we're offering. So this year, we have the ability for our clients to not only donate, but have a chance to win a nice prize as well. So from now and through until February 28th, we're accepting donations in the form of raffle tickets. And so what happens is it's a 50-50 raffle. Half the money raised will go directly to JWB Cares to build that house, hopefully 2 houses next year. And the other 50% that we raise will go to the form of you if you're the lucky winner and your ticket is pulled. So Pablo, if you wouldn't mind, go ahead and put that link in the chat box there. There is a way for you all to go ahead and be a part of the raffle. And the tickets cost $10 per ticket, but if you donate $100, you get 25 tickets. So the more that you donate, the better the deal is. But I know that you all are doing this for the ability to change somebody's life. And that's the real reason that we're doing this. So thank you all in advance. I hope you guys join us on our mission here and give whatever you can to help support the mission here at JWB Cares. It's absolutely the best day of the year, and it's coming up pretty soon.
I'm really excited, man. Last year, that's kind of when we really started talking about launching the Not Your Average Investor Show, the last golf tournament, right? Like you and me had kind of spoken about content at your volleyball tournament. I was already showing up to all JWB athletic events, thanks to Whitney Ritchie, right?
That's right.
And Whitney actually didn't hire me. She's just like, hey man, come be the hype man at my sponsorship tent. So I just showed up to like have a good time and make sure everybody was doing well. And that's where we reconnected. So now I get to tell Whitney, you know what? I got a promotion this year. I went from being the hype man of your tent to being the hype man of the tournament. So I'm really, really pumped up about it. I put the donation link in the chat for anybody that wants to donate and help a veteran get a home. Lee Bishop asks, it's $1,500 to golf, right?
Oh, you know what? So all the sponsors, I think what Lee's asking about is what it costs to actually take part in the tournament. All of the golfing spots have been filled. We're less than a month away. So all of the sponsorships and all of the golfing spots this year have been filled. So I do think it was $1,500 per, somewhere around there. So unfortunately, no opportunities now, but next year, we are looking for sponsorships. We're looking for others to take part in as well. Obviously that's a year away. So we're focusing on the first one now, but for those who would like to take part in it be here, golf, be a sponsor, we're always open to that as well. And we'll get you in touch with our team for that too.
Lee, you may not be able to golf, but if you come down to Jacksonville, you can officially hang out with me the whole tournament and be my co-hype man, my friend. Just, I'll give you that. And
I think Lee would take my job here pretty soon. It's going to be the Lee and Pablo show soon.
Maybe. You never know, Greg. You got to keep your game tight. But for right now, we're going to talk about the star of the show, and that is our rental income property of the week. Week. This home, as previously stated, is only $121,000, and JWB covers your first $1.5K of maintenance costs. It generates over 10% estimated ROI and is surrounded by dozens of other JWB managed properties. And it's at a special address near and dear to Greg's heart. And that is 664445 Cleveland Road. Greg likes to say that the best part about Cleveland is the street named after Cleveland inside Jacksonville. So
that's so good.
This is that street. We have the property up here on the screen for our friends that are listening to us in the podcast. At some point in the future, we're looking at a single story home. Looks like built on concrete brick. Again, purchase price of $121,000. Estimated rent range of $850 to $900. Lease for 2 or 3 years at $875. It's got, and this is what you're buying here, right? It's got an estimated conventional financing total monthly cash flow of $173. And an estimated conventional financing total ROI of 10.07%. Greg, let's do what we usually do. I'm going to tell our friends that are here with us, start popping in the questions. We're going to get straight to them. But for right now, I just want Gregg explain what is the estimated conventional financing total monthly cash flow mean? What is included in that $173 a month?
Absolutely. That cash flow stream is what you're buying. That's what I want you to pay attention first. And along with the return on investment, which we're going to talk about in just a second, that's what you should be looking at before you start looking at purchase price and rents and pictures and all this other stuff to find out if this is a potential deal. This is something you should potentially invest your money in. Look at what income it's going to return for you and what that income is on a return on investment basis. So that $173, what that takes into account is everything that happens on a normal month. And a normal month for a rental property is where your property management team, for you, JWB, is collecting the rent for you. And then you're paying your principal, your interest, your property taxes, and your insurance costs, along with your property management fees. So that's being deducted out of the rental income. And what would be left over on a normal month in this property's case is $173 estimated. So that is what we call your monthly cash flow on a normal month. Now, that doesn't take into account everything, Pablo, right? There are other things that happen, both positive and negative. And the reason that I want you to look at both the rental income, meaning the monthly positive cash flow, $173, and the return on investment is because the return on investment is the great equalizer. So that 10.07% takes into account that monthly cash flow. It also takes into account other profit centers, and it takes into account other expenses that happen sometimes. Not all the time, but they're going to happen at some point. And what it does is it divides it by your initial investment. And so the market right now is bearing between 8 to 10% returns. And when we show a property here at 10.07, that's part of the reason why I chose this out of the property of the week. It's really high on the return scale. Now, what that means, that return on investment takes into account your rental income minus what I just described, right? Your principal, your interest, your taxes, your insurance, your property management costs, but it also takes into account other costs. All right. It takes into account a full year or the full amount of your tenant placement fees, right? Tenant placement fees are equal to 1 month's rent. So it takes that out of the equation, right? It lowers the return. You want to include this cost. It also includes your estimated maintenance and vacancy costs. These are costs that we know from our experience that you're going to receive, you're going to have over time, just don't know when they're going to happen. So it includes those costs. Also includes some positive things, your principal pay down, which is where your resident is paying your loan down for you. It's a positive thing. It increases your return. And it also takes into account your estimated tax savings. This is all the tax advantages that you get with owning rental properties and equating the dollars of the amount of money you don't have to spend on taxes when you earn this income compared to another asset class. So you take all that into the account and then you divide it by your initial investment. And that's how you get to that 10.07% return on investment.
Beautiful and succinct, Gregg. I explain it as you know, a new investor myself. I look at this $173 of, you know, what was forecasted in my investment, and I think, okay, that's going to hit my pocket every single month, except for every once in a while when there's something that is included in this, you know, 6% or 3% vacancy rate. But this ROI is kind of like what my money is doing for me long term, right? This idea that the day that I go to sell this property or however long it just stays within my family and, you know, I give it to my goddaughter or something like that, that is what the long-term return is. And, you know, we already have questions, right? So before we talk about the one thing that you left out, that is a profit center that we know that people come to Jacksonville for, this appreciation rate that we have here at 0%, let's go straight into the questions. We love questions. So Mike Foster has a question already. Do smaller rental properties like this one tend to incur smaller repair costs over the years?
You know, I haven't looked at that in a while, but I don't really think so. I mean, generally speaking, your biggest return or your biggest maintenance costs are going to be at the property turn. And, you know, so it's not so much about like the size of the house. It's really about the length of time that you were able to wait until you had a property turn is going to be your greatest determining factor of really what your overall maintenance costs are. Now, I see your point, and I'm kind of curious now. I'm actually going to go back and look over the data that we have and see what I can come up with and see if that has actually mattered at all. But I think a much better correlation would be length of residence stay. And that's why we sign long-term leases and get so excited about renewals. So that'll be your greatest determining factor. I mean, I think your point's valid, where if you had the same property and it had the same amount of residence stay and it was a larger property versus a smaller property, could you make an argument that it would tend to have more repair costs? Maybe, but I think that's a much smaller correlating factor than length of residence stay.
It is an interesting question, right? Because if you think that this 6% number is the maintenance rate, then ergo, higher the price, the higher the maintenance cost is, right? But I guess it's kind of all relative, because at the end of the day, you're backing it out into this ROI, right? So if it were that way, would that just basically mean that a higher priced property, you should hold a bigger reserve because you are investing, like is the reserve that you need to keep correlated to the percentage of the property price, or is the reserve that you need to keep from what you see anecdotally, just like $6,000 period?
So the way that I help people plan for reserves is 3 to 6 months of your expenses. And you might have heard that before, right? That's kind of generally accepted for your personal expenses, right? How do you prepare for a rainy day? You take what you're spending every single month personally, and you put that aside for your expenses, for your rainy day fund. 3 to 6 months is generally what people do. So it's the same thing with rental properties, right? So your expenses would be your principal, interest, taxes, insurance, and your management, or excuse me, yes, your management fees, along with your maintenance and vacancy costs, right? So you figure out what that is, and then you plan for 3 to 6 months. Generally, that comes out somewhere around, let's call it the $5,000 level, right? $3,000 to maybe $6,000 is generally what you'll want to have sort of in a liquid account to prepare for a rainy day. So to your question, like, should you set aside more for a higher priced home? Well, yes, because your expenses are going to be more for a higher priced home, right? 3 to 6 months of expenses for a $240,000 house are going to be more than 3 to 6 months of expenses for a $120,000 house. So yeah, you'll set aside more, but on a percentage basis, it should be the same.
All right. Makes a lot of sense. Chad Willis asks, based on the prior purchase price and what it is selling for now at $121,000, what is the appreciation percent?
Well, Chad, it's a great question. I think we're confusing a couple of things though. So the what you're seeing now is this house in a renovated state. I don't know what it sold for prior, but the state that it was in prior, if it sold for something dramatically less, that's not comparing like real market appreciation, right? That's like went from a distressed asset to a market value asset. So you wouldn't really think about like that in terms of like home price appreciation. When we're talking about the appreciation rate, we're assuming that the two things we're comparing, or the many houses we're comparing in a market, are all basically not distressed, right? Those are like real market value properties. So I don't know what this sold for before. I didn't even look at what the state was before of this one, like how distressed it was, how much work it needed, whatnot. And so, but I do know what the appreciation rate of that home should be over the long haul, right? When you're thinking about home price appreciation, again, you shouldn't be looking at it year over year. You should be looking at this if you have the lens of buying and holding for a full market cycle. That's really when you can actually determine, and you should be counting on home price appreciation. So for this house in the Jacksonville market, you would look at the long-term appreciation rate of our market, which since 1991 is 4.3% on average here in Jacksonville. And that's 19% more than the national average, which is really important to know, because for most markets where you are a coastal city, you are also going to get like positive cash flow. Like, most markets don't have both of those things. Most markets that have positive cash flow actually are below the national average for home price appreciation. So the fact that Jacksonville it has positive cash flow like we're seeing here, and is a coastal city, which has shown to grow more than the national average, is really compelling. I hope people pay close attention to that, because you just don't see that very often. So if you're coming at it from the lens of buying and holding from a full market cycle, this should appreciate on average year over year 4.3%, but it's not going to be every year. You're going to have some that's going to be higher than that. You're going to have some that's going to be appreciating at a rate that's less than that. And after you look back after a 20-year cycle, you'll look back and you'll probably see it right around 4.3% appreciation.
Gregg, I got a question for you. What city has positive cash flow less than the average of national home appreciation and rhymes with Cleveland?
Cleveland, you know what? That is Cleveland. There you go. Right. And I wanted to share with, I needed to like bear a part of my soul here that I have been talking trash about Cleveland. Like, and for anybody who's new to the show, it's because I'm from Pittsburgh. My whole family's from Pittsburgh. And you know what, if you're from Pittsburgh, you talk trash on Cleveland. And if you're from Cleveland, you talk trash on Pittsburgh. We get it. So it also happens to be a real estate market that some people choose to invest in rental properties. And so I always let people know that Cleveland has appreciated at a rate of almost half of what the Jacksonville market has appreciated of. And that's for the last 30 years. So I do tend to beat up on Cleveland a lot. I do it on purpose. There's a very real reason why I do it. It's more about my love for the Pittsburgh Steelers and because I think that appreciation matters over the long haul. But I do need to have a peace offering for the city of Cleveland. This is my peace offering to recommend a property of the week. To choose this one on Cleveland Road is my peace offering because the Cleveland Browns beat the Pittsburgh Steelers in the playoffs this year. And I had to eat all of my words. I was talking a lot of trash the entire season as the Steelers were undefeated. Never in a million years would have thought that we would be sitting here today talking about how the Steelers lost. So this is my peace offering. This is helping it get off of my chest now. And hopefully, that there's some good to be done here.
I'm glad you're being the bigger person, Gregg. That wasn't just a beating by Cleveland. That was a beating by Cleveland. So, I'm glad you've gotten over it, man. You're a big man. Speaking of home price appreciation though, Gregg, I got a couple questions on that. Number one, you just mentioned that historically home price appreciation in Jacksonville, 4.3%, 19% higher than the national average. But on our call on Tuesday, when you're talking about the state of the market, you talked about this idea that you're expecting this year to be 8 to 10% home price appreciation.
Yeah.
Do you know how that compares to the rest of the, like what the national average expected home price appreciation is?
I don't know. I know it's more than what the historical average has been though. The historical average is about 3.6% going back since 1991. It's been about 3.6%. So I know that across the country, you're seeing very low inventory in almost every market out there. And so when you have low inventory and you also have really high demand, right, that is a recipe for housing prices to go up. So I don't know exactly what the overall guess is for the entire country. I also don't think it really matters. There's no real national real estate market. There's a collection of local metropolitan real estate markets. So it really doesn't even matter, I don't think, as far as kind of like what the national average is. But 8 to 10% is definitely on the high side.
Yeah, I would imagine so. And listen, at the end of the day, coastal city, like the quality of life of living in Jacksonville is really, really special. Like I feel like it's like the best kept secret ever. And now the secret's starting to get out and you're never going to say this, right? But I think the higher home price appreciation thing is here to stay. And it's one of the reasons I left Miami to come here, right? Like I felt like Miami had topped out. And I think there's all these trends that are going to continue to feed Cleveland, to feed Jacksonville.
Well, let's kind of take that to another level. So you were saying that you feel like home price appreciation higher than normal home price appreciation is here to stay. What would limit it?
What would limit it would be demand of housing for Jacksonville properties, right? And I think, and versus the amount of supply that can come to the market, right? So my opinion is that these trends that snowbirds are moving down to Jacksonville and staying, right? Like this thing that COVID really put on fast forward, this idea that you don't have to live in a really cold place that is miserable 8 months out of the year just because your job is there. And nowadays you can transact business, You can move headquarters. You don't need to be right next to Wall Street. You don't need to be wherever because of digital trends. I think that more and more companies, to attract better talent, are going to move to warm weather cities. And I think that Jacksonville, where it is right now, based on its economy and its mix of things, is going to continue to attract better businesses. And therefore, that demand of a place to live that feels like Southern California, but has the price of Montgomery, Alabama, like, is really, really good, man. So I just think psychologically, it just makes sense to me, man. That's why I'm here.
And you're right. You're absolutely right about what you're talking about. Population growth has been happening here for decades, and it should continue to increase, right? I guess I was going to give you the other side of it, though. The demand and the supply equation is one very big part of it. So like, while we have really low inventory and really high demand, you're going to see housing prices go up, but it won't go up this way for the long haul, right? It's going to come back to right around that 4.3% number when you give it a 10 to 20 year cycle. And the reason is because at some point, it doesn't matter what demand is or supply is, if people can't afford housing, so that's why it's so important for us to also see wage increases, median income increases in Jacksonville. And that's one reason why we are such a big proponent of downtown Jacksonville. It's because that is an opportunity for us. While the real estate market is incredible for us right now, the long-term win is we need to make sure that we keep bringing high quality talent here, keep bringing jobs to Jacksonville, have a thriving urban and walkable downtown where people want to be, so that median incomes continue to rise. Because what you're seeing in the places where median incomes haven't risen as much as they need to, and housing prices have skyrocketed, think of California, right? Doesn't matter what demand is. If people can't afford to buy the house, housing prices are going to be capped off. And at some point, so this won't always be a seller's market. If I'm thinking 5 years down the road, 10 years, I don't know when it is, but I know at some point we're going to think about this time as a very special moment in time, and it won't feel like it again. And that's why this idea of how appreciation works is so relative to us as rental property investors. We need to be investing for the long haul. And I don't want you to take the fact that I think housing prices are going to go up 8 to 10% next year and say, that's what I'm going to see every single year. I want you to use that to your advantage, to know that today's prices are better than what they probably are going to be next year. But still keep in mind that you're probably going to see an average of 4.3% appreciation once you look over this with a very long-term lens.
I think that you are very wise and you're very transparent, and obviously you have consumers' best interests in mind, to like not set a too high expectation. You like to underpromise and overdeliver. Coming from a market where real estate has gone bananas and nobody cares about whether it's livable or not, being Miami, I've seen the other side of the coin of just, there's so many rich people in the world, and there's only so many really nice weather urban areas with a beach that people can live in. And we're going to continue to draw, like once Miami goes underwater with sea level rise or just gets completely saturated, we're going to start drawing rich South Americans and Europeans and New Yorkers and whatnot, just because we live in this place with amazing climate and beautiful nature, yeah. I just think there's a really, really high ceiling that will bring in so much outside money that the wages, it may be really hard to live in Jacksonville when you're not being a have-not, which it is in Miami, but harder than it is right now. Right. Like, but I just see a really high ceiling having lived that experience. Right.
Yeah, I'm with you. I mean, there certainly is upside.
Yeah, there's upside. All right. So enough about us upside. Let's talk about Paul Schaefer. Paul Schaefer had originally asked, has this house been rehabbed? You mentioned that this house has been rehabbed, and what he would love to see is a schedule of work. Or if you don't have the exact schedule of work, Greg, what is the usual rehabbing that goes into turning over a property like this?
Yeah, there's a standard. There's a JWB standard that we have to hit, and we have to make sure that there's no deferred maintenance. We need to make sure that the major mechanical systems are sound, either newly replaced or recently updated. And then we need to make sure that the house is in great shape from a rent ready perspective. Cosmetically, it needs to be buttoned up. Now, I use terms like buttoned up, not not terms like perfect, right? Right. This is a rental house. So we need to make sure that we're preparing for the house to have somebody live in it, and also make sure that your maintenance and your vacancy costs are low. So we do have a scope of work on every house. So that certainly is something that we can provide. The standards, as I mentioned, your major mechanical systems, meaning the AC, the roof, the electrical, the plumbing, all of those major things have been inspected. We make sure that they're either brand new or they're up to our specifications. And then everything else, there has to be a hard surface in the living areas. Appliances need to be in there and brand new. Things like that are always a part of our scope of work. But I did want to point out one thing, and this is a great segue into it. This house also comes with a $1,500 maintenance credit to the buyer. And so this house, actually, when we actually acquire a house like this, we look at it and we see, is this going to meet the JWB standard for our homes? And for this one, we purchased this through one of our marketing partnerships, or our Jacksonville real estate market partnerships here. So basically, we acquire this home and it is currently being marketed for rent. And so when we do that, we go and we look at the house and we say, is it to our standard? And for this house, what we determine is that it is to our standard as far as renting the house out today, but there's also a few things that we would do differently than the previous owner of this house. And these aren't things that are going to affect the rentability today, but they're things that we want to make sure you're always up to our standard. So that's where that $1,500 that maintenance credit comes in. So I went ahead and looked at what that credit really is. For us on this one doesn't have a shed in the backyard. So our standard for a house like this is that we would have put a shed on this home to rent it out. And so we're going to give somebody $590, we're going to give somebody that $1,500 credit who purchases this home. $590 of that, the reason we came to $1,590 is what we would have spent on the shed. And then we included a moisture barrier, $400. So we're going to make sure that those things are there and they're accounted for you. And then over time, when the property turn comes up, we're going to do those things to make sure that your house is really kind of up to our standards. So it's in a great shape today to rent it out. It's actively being marketed. It's met our standard, but our standard is a lot higher than everybody else's. And sometimes we're going to do some extra things to make sure that your investment's protected. And that's where that $1,500 maintenance credit comes in.
That's pretty gentlemanly of you there, Gregg and JWB team. All right. Chad Zach, who's got a great first name and great two first names, two last names. I'm a big fan of those types of names. Chad Zach asked the question, will the preferred lender allow me to tap into HELOC to cover down payment and closing costs? Also, are any additional funds needed to get started?
That's a great question, Chad. Yes, we have many clients that tap into their home equity line of credit as a way to raise capital to then be able to buy their investment properties. So a great example of this would be you live in California and your house is appreciated like gangbusters over the last 5 years. And you go out and you get a home equity line of credit on your primary residence to sort of tap into some of that equity and start to use some of that equity to your advantage. And the interest rate on your home equity line of credit is really small right now. And so you may have $100,000 of equity in your primary residence. You get that access to it through the home equity line of credit. And then you might come over to Jacksonville and you might use that as down payments on 2 rental properties here with JWB. And then so you use that money as the down payment. And then with the lender that we select with you and for you, you're going to then be able to get the debt from their bank to be able to buy the asset. So it's a great strategy, and our lenders are very well versed in you being able to do that.
All right. And Paul Schaefer is putting here in the chat, tapping into HELOC for down payment. I've done it now several times. Thanks for sharing, Paul. And now we've got a question from Marilyn Cotterman, who is from Homosassa, Florida.
Home of the manatees.
All right. Marilyn asks, is this home still available to an investor right now? Is this one of these homes that we were planning on showing and then it got bought in the meantime? Or is this thing, can I buy this right now, Gregg?
I checked yesterday. Full disclosure, I did not check right before the show. So yes, to the best of my knowledge, yesterday it was available. That's not to say that it couldn't have changed status in the last day. But yeah, I'm pretty sure this one's still available.
All right, man. So not for long, for the record, because I'm liking this house, and I'm coming close to my capital gains moment where I can cash out some stock. So Nadeem Shah, welcome back, Nadeem. Good to have you back. Asks, how hard is it to sell these rental properties after a few years if one wants to sell?
It's a great question, Nadeem. So, I mean, the first thing that I would want to make sure is that if you're coming into this asset class, you want to buy and hold for a long time. And you've been on the show a few times now, so you've definitely heard me talk about how buying and holding for a full market cycle, 10 to 20 years, is the best return on your investment, because then you can start to count on the effects of positive home price appreciation. And when you capitalize on that, also while you're using financing, we're able to show how returns can be over 20% when you go down that route. So I would caution you, if your thought is that you're going to be selling in the next few years, the estimated returns change, in my opinion, because you can no longer count on expected home price appreciation. For us, when we bring new clients on, we're going to ask you how long you plan to hold on to this asset as well. And if you share with us that you're thinking you might want to sell in the next few years, that we're probably going to politely say, hey, listen, I don't think this is the right fit. And that's us coming from a place of wanting to make sure that your investment is protected. Because if you plan on holding for less than 5 years, you're basically counting on a lot of appreciation to be able to sell this asset and be able to account for the selling, holding, and transaction costs that come along with selling, right? Another way of saying that is if you want to buy this thing and then sell it next year, the market could go up in value, but you still might not be able to get all of your money out of this investment because you have to pay a realtor 6% and you have a couple other percent in closing costs and all this other stuff. So we really stick to only bringing clients on that want to hold for a minimum of 5 years. So that's just kind of the standard approach. Now, how hard is it to sell? Let's assume that you're either holding on for 5 years, or if life happens, it has happened. We serve over 1,200 clients and they need to sell at some point less than 5 years. It's generally very smooth and easy. Your portfolio manager is there talking with you every single month, and they're very into an understanding of what your goals are. We build your plan with you. We know what's going on as far as your investment vehicles. And then quite frankly, we get to know a lot about you because you get to talk to us once a month and we build a relationship. When that happens, if there's something that needs to happen and something unforeseen happens and you need to sell, you're going to have that discussion with my team. We're going to help you understand what the best method for you is to sell. Most of the time, what's going to be the best method for you is to get the best return on your investment. You're going to want to sell to somebody who's going to live in that house, right? Because generally speaking, if you're selling it on the market to an owner occupant, you're going to get a higher price, right? If you go and you sell to an investor, you generally have to sell at a discount to market value. So what we're first going to look at is where's the best opportunity for you to get the top dollar for your sale. And then if that is selling on the market to an owner occupant, we're going to refer you to a real estate agent team that we trust, that we've done an extensive amount of business with over the years, and actually sell some of our properties that we have sold to owner occupants. And so we would make that connection. We would, of course, make sure you're in a good spot there. And then the sales process is generally very smooth. And if there were other options or other things that were important to you other than top dollar, right? If timeline was really important, we're going to be there to come up with solutions for you all along the way. So don't think of it as this big challenging process to unload the asset. Listen, we know exactly, we've got options upon options upon options. The most important thing is you're going to be talking to your portfolio manager, and we're going to find the best solution for you.
And with, what is the months of inventory right now, Greg?
Yeah, exactly. So months of inventory is a metric to measure how many houses are on the market overall, like Jacksonville, versus how many have sold. And it's literally never been lower. I've never seen it lower. And the lower it is, the easier it is to sell your house. Right now, it's 1.3 months of inventory. Generally speaking, between 6 to 7 months of inventory is an equilibrium market. And as I mentioned, I've never seen it at 1.3 months of inventory, which is where it is now.
So it's moving quickly, man. I can tell you before I decided I'd buy an investment property, I was looking at buying a house. And it was one of these things. This was 9 months ago, right? Like this was way before. I think months of inventory was like at 2 point something. And we would see a listing talk to a realtor and it was gone. It was like the property of the week or something like that.
Yeah, exactly.
All right. Marilyn Cotterman from Homosassa, Florida has another question. Would you calculate what the approximate price would be for a 4.3 appreciation in 10 or 20 years? Is there somewhere that I can do this?
You know what? If we go to the next question, I'll kind of do this in the background. There's, you know what? Or actually, you know what? How about I just show everybody how I do it?
How about it?
All right, cool. So, and then you can all do this the same way. Probably just gotta allow me to share the screen, brother.
You are ready to go, buddy.
I am ready to rock and roll. All right. And Paulo, just let me make sure that everybody can see. You're seeing the Google screen here, right?
I'm seeing the googly screen.
The googly screen. All right. So home price appreciation calculator. If you want to see what home price is in 10 or 20 years, here's what you'll do. Type that in. I tend to go with this one, good calculators, because it makes me feel good. So there you go. Choose good calculators. You can come here. It's your home price appreciation calculator. And you can calculate either the home price appreciation rate or you can do the future home value. And so for this one, we're going to keep it in dollars. Your purchase price is $121,000 right now. And then you can put in your average appreciation rate of 4.3%. And then you've got years since purchase. And you calculate this home, if it appreciated at that rate of 4.3%, would be worth $184,000 in 10 years, which is pretty cool.
There you go.
If we want to see it in 20 years, that now is up to $280,848 in 20 years, which is really cool. And then if you think about the principal pay down that has been going on at this time, that's where it gets really exciting because, you know, for this property, your loan is going to be, call it 75% of 121,000, right? Call that like $80,000 is your original loan when you know, of course, buy this property, Maryland. And then in 20 years,
it's almost 90,000 on the dot if it's 25%.
Yeah, there you go. Right, yeah. There you go. I'm glad somebody knows math around here. So 90,000. So you got 90,000 there, right? In 20 years, the vast majority of that loan is going to be paid down. And guess who paid it down? It's your resident. It's your resident who paid it down with the monthly cash flow coming to you. So not only is it worth 280, but you don't owe 90 on it anymore. You might owe 20 on it. So your equity spread is almost all of that at that point. And that's why I really help people see all of the profit centers. Because if you look back over a 10 or a 20-year segment, it's not just the cash flow that you get. It's not just the home price appreciation. It's also the principal pay down. That's real return on investment for you. It's also the tax savings that you've got all along the way. So yeah, great little exercise there. And you guys can just do that and play around with the numbers just like Pablo and I do.
While we are exercising, Greg, I think we should absolutely do this little exercise that we like to do, right? And that is why don't we look at what that ROI looks like for a home when you put in 4.3% appreciation, right? Because we've been showing you this at 0% appreciation because we're not counting on it. But if you are counting on it, you are going to be there for 20 years. When you put in 4.3 appreciation, you get to 25.71% ROI. You want to explain that real quick, Greg?
Yeah, absolutely. This is the power of leverage. And right now there is such an opportunity for people to fully embrace how to use smart debt, smart leverage to your advantage. The best thing about leverage is that when you're investing in an asset that has shown to go up in value over time, over the long haul, like rental properties has shown, when the market value goes up, if you only put a small percentage of the amount down into the deal and the bank covered the rest, your returns on investment skyrocket. And so here's an example, right? If let's just say that the purchase price of the house is $100,000. If the market value goes up 4% that year, then it's now worth $104,000. That's a $4,000 gain just from the appreciation. If you put 25% down on that deal, you only put $25,000 into the deal. You didn't put all $100,000 into it. You put $25,000. So your return on investment is calculated by the return, the dollar, the $4,000 divided by what you put into it. And you put 25,000 into it. So if you want to do that calculation, 4,000 divided by 25,000 equals 16%. And the real return on investment, because you're able to use smart leverage and smart debt, is actually a 16% return on investment. And as if we go and look at what Pablo just did here, that's in essence why your return on investment jumped up from right around 10% to right around 26%. It's because you got four times the value of the appreciation because you only put 25% down in the deal. So that's why smart debt is such an asset.
That one took me a while to really, really digest, man. But the more we talk about it, the more I'm just like blown away by the magic of it, right? Like, and it's the idea of if you can spend $20,000 to get the benefits of $100,000, that's what's happening, right? In investing. Like, there's no way that I'm going to buy $100,000 worth of stock with $20,000. That's just never going to happen.
Yeah. And if you compare it to the stock market, right? Historically, people know that, given it enough time, stocks generally perform at somewhere between 7 to maybe 9% return on investment. Like, let's speak the same language. That's appreciation. That's what the stock market is touting, right? 7 to 9% from appreciation, right? We're not talking about net rental income or dividends, right? We're not talking about tax savings, right? You don't get much of that, right? We're not talking about principal pay down or anything in the stock market, right? It's one profit center. It's called stock appreciation. In rental properties, you've got 5 profit centers, right? You've got net rental income, which is like a dividend in the stock market, right? You've got tax savings, which you just don't get in the stock market, right? You've got principal pay down, right? Which you don't get in the stock market because you can't get a loan to buy stocks, right? You've got home price appreciation, which you get in the stock market. But the difference here is that when you capitalize on debt, right? Home price appreciation is like, if you only put 25% down, you only need the market to go up 2% to generate an 8% return on investment. Comparing that to the stock market over time, you're seeing that the market generally over time performs at 7 to 9% on stock appreciation. So that's why when you're really comparing apples to apples, I love rental properties because I see it as being more upside than the stock market and less risky than the stock market, right? And more consistent than the stock market. So that's why I love it so much. But it's very easy to get to 7 to 9%, which is what you get in the stock market. But it gets even easier if you understand how to use smart debt to your advantage. Like, that is really where you can really skyrocket your returns in rental properties.
It's genius stuff, man. And Leo in the chat, every time we're talking about this concept, there is the requisite rich dad, poor dad reference, right? Leo puts in, I heard about Gregg's analogy via rich dad, poor dad. In real estate, you have this leverage. And it's amazing how many people, how that book has taught that principle to so many people. And, I think that is a big reason why most people that are on the show have read that book. I'm the other way around. I heard about it 1,000 times and then somebody beat me. And then, I got peer pressured by wanting to be a part of this tribe to read that book. But yeah, man, it's absolutely phenomenal. Gregg, we got a couple more questions here. Let's knock these out. Okay. Leo asks, for this property, if the buyer wants that shed, can the buyer just let JWB install that shed and deduct it from the incentive?
I don't think so. I mean, there's a real reason that we include it as an incentive, meaning that $1,500 maintenance credit. I don't exactly know the reason why, to be quite honest, but I know that. But I know there's a real reason. Either it's better for the resident or the potential resident, or it's just not going to negatively affect your return on investment. Like, I think what it is, and I could be wrong on this. I didn't check this before, but I think the thought is, a shed is going to be there if, we would have put the shed in there to rent it out quickly, right? I think there's a decent chance here that you're able to rent the house out without a shed. And so you might be able to get that long-term resident and they might not need the shed. And then in that case, it'd be better for you to actually keep that, $1,500 credit going to you to increase your rates of return. So I think that's, and I'm coming up with this, so might not be 100%. I haven't checked with the sales team on why we did it this way, but that would make sense to me. That's better for you long term. Let's see if we can get this thing rented out. I'm sure we can without it. And then let's just throw that $1,500 to your return on investment in the form of wiping away your first $1,500 of maintenance cost.
There you go. And listen, at the end of the day, what I'm hearing in that question, after having been on so many of these shows, is a question that somebody that's going to live in the house. Like, if I'm going to live in the house and I want a shed, maybe I don't want you to remove that shed. But if you're buying this home, don't forget that this is for your tenant, and JWB knows what tenants need for your own interest, right?
Well, it's not removing the shed. This would be us adding a shed onto it, which maybe, I mean, you might not need that. I mean, we were going to do it anyways. So we're going to make sure that you have that going towards your return on investment. But if we feel pretty confident that you might not have needed it, then it's better served for you to not have $1,500 of maintenance costs rather than buying a shed that your resident didn't necessarily need. So that would be the reason why.
Makes sense. Marilyn Cotterman from Homosassa, Florida asks, what percent?
Home of the manatee.
What percent do you need to put down for using self-directed investing on this home?
What percentage do you need to put down for using self-directed investing? So when you're buying with your retirement accounts, that's another way of saying using self-directed investing. You have the option to buy it all in cash, which is putting 100% down, but you also have the opportunity to get financing on it. Now, getting a loan on a property that's purchased in your retirement account is completely different than getting a loan to buy a property that is outside of your retirement account. Up until now, you've heard me talk about either putting 20% down or 25%. That's when you're buying outside of your retirement account. When you're buying inside of your retirement account, you have to put down more, because the banks that will actually lend to your retirement account are very few and far between, and they need to have more security in the loan for them to do it. So you'll typically expect to put 50% down. That's 50% down to get a loan to buy a property in your retirement account.
All right, there you go. And I pulled it up. I was looking to post a link to the raffle ticket, so I got kind of distracted. But I pulled up the property analysis here. Here's that 50%. Right here's the finance amount, down payment amount, Maryland, so you can look at. And now we have got the final question of the day from Paul Schaefer, who's had some great questions today. He says, I should know this, but forgot. What is your management fee percentage? Just running numbers in my nerdy spreadsheet. It's okay to be nerdy here, Paul. You're good. You're with good nerdy.
Welcome to the group, Paul. You fit right in. The management fee is 10% of the rents collected. So it's easy on that one. I will also let you know, Paul, that we have nerdy spreadsheets too. And the value of using our nerdy spreadsheets are that it's already built for you. So the management fee is calculated there. All of the 5 profit centers are included, and you can use that. So I highly recommend that you use one spreadsheet to compare all of your potential rental property investments, whatever market you're in. And so we can do that. So you can go to jwbpassiveguide.com and just request the guide. It's a part of it. It'll be emailed to you, and then you can just kind of use that going forward.
Yeah, there you go. And, at the end of the day, Paul, you can at the very least compare your nerdiness to Gregg's nerdiness and see whose nerdiness wins with these sheets. So, I recommend it. It's a super functional sheet. Like I'm kind of an idiot on Excel, and I have maybe we've done this, like 30 times, Gregg. I've only broken it once. So it's pretty good.
There we go. If Pablo can do it, you can do it, Paul.
Yeah, exactly. And Gregg, do you know the approximate interest rate on self-directed?
Yeah, about 7.75% for a loan.
7.7. All right, cool. And we got one last one. What are the anticipated interest rates offered to LLC owners in current market conditions? Do you know about that?
So now we're talking about a slightly different thing. So when you're buying properties outside of your retirement accounts, to get the best rates, those 4% interest rates like we talk about, or putting 20 or 25% down, you're going to get what's called conventional financing. Conventional financing does not allow you to buy the property in the name of an LLC. So if you really want to close in the name of an LLC, you have to go with a slightly different product that can be purchased outside of your retirement accounts in the name of an LLC. We have the ability to do it. I don't really know what the difference in rates would be, but probably I'm gonna ballpark it a couple percent. maybe 2, maybe 3%. So it'll be a substantial hike to do that. So there is another way that a lot of our clients buy properties, and they get the best rates on financing, but the properties end up in the name of their LLC. And this is something that we would be happy to walk you through how our clients do this. So there's a better way that a lot of people use. So I know we won't have too much time. I know the show's ending up here. So what I'd encourage you to do is to reach out to my team and jump on a call with us. Happy to walk you through how our clients do that. And you can set up a time to do that at chatwithjwb.com and go through that process of deeding into an LLC.
There you go. If you're going to deed it, you're going to do it with JWB. All right. I was working on something there. Didn't work out. I want to thank everybody for showing up, Gregg. Another POTW, another rental income property of the week.
Week.
This is the most fun of my week. I love these calls. I really appreciate everybody that shows up, makes this show your own, right? Like Paul, thank you for the great questions today. Marilyn, like everybody had really, really good questions. You make it so easy for us. And the opportunity that, you take an hour of your day on a Thursday to just hang out with us is something that we never take for granted. It really, really fills my bucket. I know it fills Gregg's bucket. I put in the chat again, if you want to get in on that 50-50 raffle, right? Like whether you like to gamble and want to make some money, or whether you just want to help a veteran out, I recommend it, right? Like put $50 on it, put $100 on it. It's going to be for a good cause, and you might make some money on it. And, we link to the passive guide in there. If you want to download this nerdy sheet over here, it's awesome. Check it out, jwbpassiveguide.com. And Gregg, I'm going to leave it up to you for the last call here.
Yeah. Lastly here, didn't want to forget about the client only meeting that's coming up on Monday. So a lot of our folks that are here with us now are current clients of JWB. We set aside time every quarter, and we're going to sit down and go over the state of JWB property management. We're going to talk about rent collection. We're going to give you the end of year stats from 2020. So you can see how we're performing, how your assets are performing at a much larger scale. We're going to go into our Jacksonville real estate market update. We're going to talk about current inventory levels, both in the marketplace and here at JWB. And we're going to talk a lot about where we see the market going, where we see your best opportunities to maximize your return on investment. So this is only for our clients that own turnkey rental properties. So if you haven't received that invitation to be a part of that call, go ahead and reach out to your portfolio manager. We'll get that link over to you. And we are super looking forward to that call on Monday. And for everybody who is not a current turnkey client yet, I don't want you to feel like you're getting the shaft here. We are going to do a very similar call on Tuesday of next week. And we'll have the forum there for everybody to be able to ask questions, get that insight on Tuesday. So super looking forward to Monday and Tuesday next week. It's going to be a really cool moment to share past performance and also talk about some opportunities for maximizing returns in the future.
All right. See you next week.
Thank you, everybody.
Bye-bye.